Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
That's right. It's a bigger picture with me, Ryan and Imad this morning.
Have you noticed a difference when you've observed footfall in restaurants recently?
So you're talking about going out,
Yes.
chilling with friends. I don't do that as much these days. And when I do, it is actually a bit quieter than usual. Have you noticed that?
Yeah, I used to find it pretty hard to make reservations at restaurants last year. This year, I find it a lot easier. Is that a sign that the times are changing?
It could be. Maybe it's reflected in the latest numbers out this morning in the first quarter GDP data for Singapore, where we have the economy growing by 3.9%, even though it's just above the earlier advanced estimates of 3.8%. This is still a slowdown from the 5% growth clocked in the fourth quarter of last year.
There's still a silver lining in the cloud, and that is that Singapore has maintained its growth forecast for the year at a range of 0 to 2%, even as the data showed the economy grew slightly faster than expected in Q1 2025. And this is where we bring in our expert, Barnabas Gan, Group Chief Economist and Head of Market Research at RHB Bank, Berhad. Good morning, Barnabas.
Good morning, everybody. How are you?
Let's get things started first, Barnabas. If your overview of where things are right now, how do they fall in line with expectations, 3.9%?
I mean, very clearly, you see the numbers at hand above expectations. We were calling for a slower number, in fact, at 3.6%. And this is really due to the disappointing manufacturing numbers that were seen in March. But the 3.9% is very welcoming. We are happy with the number. But I think overall, the issue is that we are still seeing somewhat of a slowing sectoral numbers on a Q-on-Q basis. And that is really being seen in manufacturing and construction. Probably unit services is the only one that is really holding the growth momentum. But that basically also suggests that some of the pains that were seen since the start of the year, from tariff, from the slowdown in sentiment and confidence, has really taken a toll on the economy.
Yeah, you touched on a number of factors there, Barnabas. We'll dissect them one by one. Some of the sectors that helped drive the better-than-expected growth in Q1, as outlined by MTI, we have wholesale trade, manufacturing, finance, and insurance. Growth in manufacturing and wholesale trade likely to have been partly supported by front-loading activities ahead of the anticipated hikes by the U.S. How much front-loading effect was in play here?
I mean, if we look at the numbers at hand, Singapore, we have a very strong geographical, benefit and strategy. We are actually being located very well and positioned very well in ASEAN. And if we look at where the flows are, if we look at where ASEAN is, financial flows will likely still continue to benefit Singapore, and that's why financial services will still likely to be at the forefront of the growth for this year. But I think now we are still in fairly uncertain territories. It's still quite uncertain in the sense that we still do not know what's going on between US and China. I know that there's some, negotiations as well as some deals being made. But, look, it's only 90 days, and there is still a deadline towards 90 days reciprocal tariffs, and that basically also suggests that more pains might still be on the cards, especially if the tariff starts to be online again.
Yeah, that's a tough one to navigate, right? The tariff environment. How much do you see that holding back in terms of business activity, hiring? Might we even see layoffs or job cuts? Because we are at the same time seeing Singapore maintaining its growth forecast for this year, 0 to 2%.
No, I think it's a very modest and very realistic growth forecast, if I may add, 0 to 2%. If I could also, reinforce the fact that if there were, and I repeat, no tariffs and uncertainty issues at hand regarding this trade tensions, Singapore could easily surpass the 2% handle this year, easily. And there will likely not be any technical recession for the first half of this year. But because of the pains that we've seen in the first half, and really the somewhat weakening of the labour market now that the unemployment rate has gone up, just very slightly, but that also essentially means that some, of the pains that were seen back, during the tensions and negotiations and the decline in confidence has really dissuaded probably manufacturing. There was some support in trade, but there's also front-loading behavior in terms of exporters really moving into trying to avoid the tariffs that may come in after the reciprocal tariffs. Overall, it is quite realistic to see that Singapore could grow by 0 to 2%. Let's just wait for the second half. If things are really better, there may be a good chance for it to surpass 2%, in fact.
Yeah, Barnabas, as you rightly said, the tariffs likely to weigh on corporate confidence, which will be reflected in capex and subsequently affect the trade cycle as well. Is there a threat of sector-specific tariffs for Singapore, and if so, which ones?
There are clearly industries that would likely bear the brunt of the issues at hand. Singapore's key manufacturing capabilities, electronics, E&E, pharmaceutical, biochemicals, precision engineering, you name it. These are the key pillars, of Singapore's manufacturing. And if we are looking for, the slowdown in trade, slowdown in investment, and slowdown in confidence, then these are the few key areas that could actually be detrimental and really bear the downside bias for Singapore's overall growth for the manufacturing sector. But there are bright spots, if I could add. As I mentioned in the earlier part of the conversation, Singapore is very well positioned within ASEAN from a geographical location, as well as for the fact that, we are a financial hub within ASEAN itself. And that basically means that, despite all, there still could be a silver lining in the cloud whereby financial services could still be supported, given the status of Singapore as a financial hub within ASEAN itself.
Yeah, Barnabas, talking about growth, let's talk about what's playing out in the property space when it comes to rent. And we've seen many F&B brands starting to close shop because of rent going up. What do you make of this landscape where rent is going up? Is that a sign of a strong economy where maybe there is someone able to pay higher rent?
Rent, be it whether it's commercial rent or if it's residential rent, it's all a function of demand and supply. I think for that matter, we should not just take into regard a very superficial outlook by saying that, shops are closing because of higher rent. The reason why there's a higher rent is because someone is demanding it. That means there is demand for such a rent level at this juncture. And of course, with the shops closing, this probably just a temporal, change of hands, so to speak, in terms of whether shops will start to come in again, to take over the unoccupied space. But I think generally, if we look at just theory alone, the higher rent is just a function of demand and supply. And higher rents means someone is actually demanding the rent at this juncture.
All right. We've been in conversation with Barnabas Gan, who is the Group Chief Economist and Head of Market Research at RHB Bank, Berhad. He's been helping us break down Singapore's Q1 GDP figures for 2025. Barnabas, thank you so much for your time and insights.
Thank you. Bye-bye.
Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.